Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. If it were Friday, it'd be Friday the 13th, but it's not. It's Tuesday the 13th of August.
You crack yourself.
Guy here. By the way, if it was Friday, we wouldn't be doing market call either, but maybe in the fall that will all change. Anyways, a lot to talk about here. Guy and Dan, 1 o'clock East Coast time, market call. How are you, Dan?
I'm doing great, Guy. I mean, what a day in the markets. What a couple of days in the markets. Yesterday, we flatlined. Literally, the S&P closed unchanged on the day.
You don't see that often.
And then we got a ripper here after this PPI, which is kind of funny because it's the exact opposite of what we had late last week on that initial jobless claim.
There's a lot to dissect here, so let's go. And we got some stuff for you. So let's go right to the rundown. And Amanda has just done yeoman's work. Back from vacation, stocks rise on inflation report. Yeah, I guess. This is my favorite, though. Deer in the headlights. I mean, that's just so good. Starbucks gets a jolt off a CEO shakeup. And Dan's got a little trade and what he believes, and I actually sort of in accord, the potential next activist target. So stick around for that, Dan, Nathan.
Yeah, matter of fact. So it's interesting, Guy. You don't think this is all to do with a slightly worse than expected PPI or what? I mean, it is amazing. And we talked with Liz about this on the tape yesterday morning. Just, what a difference a week makes, right? When you think about, I think the Nikkei guy has made up all the losses from, last week, that down 12% day or something like that. So it's just amazing how quickly, investor sentiment can turn. But again, I think we're going to look at the charts, the S&P minis and stuff. We're still ways off of those previous highs.
Yeah, let's just go through a couple of things that we have. I mean, the first thing we want to look at is what's moving today. Amanda did a great job with this sort of snapshot of things. So let's take a look at that, and you'll see again. I mean, it is remarkable to me, at least, that we were waiting for 2% days for seemingly a year and a half or 2 years in terms of trading days, and now we're starting to see them almost on not a daily basis, but a few times a week. And NASDAQ, up almost 2%. You see where the SPX is. It's amazing we're seeing these kinds of moves. Now, maybe that's a function of, again, volatility being sort of pushed towards the upper end of the band. Maybe that's part of it. But there are obviously a lot of things working here. Maybe that yen carry trade has exhausted itself, so the market has moved on to the next narrative. But I only bring it up because you're clearly seeing some extreme moves in terms of ranges and volatility.
Right. So let's just think about what's going on here. You see the sectors that are moving. They move back into the Mag 7. That's the XLK, consumer discretionary, which is made up a large part by Tesla, which is up 4.5%. So that's helping that there. Guy, I'm surprised to see XLV up there. You know what I mean? Like in this sort of environment, a risk on sort of thing. But last night on CNBC's Fast Money, we had a guest that I don't remember ever having, but he is the CEO of Ladenburg Thalmann, I guess their asset management group. And he said, well, I'm going to say a couple things that are kind of, controversial, I guess he said. He does not think the Fed is going to cut in September. And I thought that was kind of interesting. And, you made this point on a couple of occasions. A, you don't think they should cut in September, but also maybe investors in the bond market have already done the work for them. If you see where the 2-year yield, which is obviously as closely correlated as any, treasury to the Fed funds rate, has gone from 5%. Here we are, down below 4% in just a matter of months.
Market's done the work for the Federal Reserve. Again, the market seemingly is trying to force the Fed's hand a little bit. I thought he did. I think his name was Phil Blancato, if I'm not mistaken. And I think he's been on once or twice before over the years. But, I think his point was, I think it was an interesting one. I do think it was somewhat controversial. He doesn't think they should cut. And I'm sort of with him. I don't see the rush. I don't see what's breaking. Now, things are deteriorating. Things are slowing, but at a pace that necessitates rate cuts. Like, I don't think so. That's the point. Now, so when you hear, 75-point emergency rate cut last week, it's just, it didn't make any sense to me, and it reeked of desperation. But that's seemingly what the market wants. So I think they should sort of, all systems go, just sort of steady as she goes and continue to sort of navigate the waters. And I've said it 100 times, and Liz talks about this as well. Be careful what you wish for in the form of rate cuts, because that's historically, at least, when the market starts to go the other way.
Yeah, I mean, I guess, but like, look at this. The moment that, we get this slightly worse than expected PPI, the stock market rages on the expectation, right, that the Fed is going to, cut. I mean, obviously, there's a near certainty if you're looking at CME Fed funds futures. Let's pull that up for a second that we get a 25 basis point cut, but it's like 50-50 whether we get 50 basis points. You know what I mean? And again, to your point, is like, if they're doing that, that looks kind of panicky, right? Because they're saying, what are they seeing that so many of these other strategists or economists who are still in the soft landing camp do not see? And we know that the Fed does not have any particular insight, at least based on the way that they have moved, Guy, over the last 10 years. They seem to be late towards everything. So, one point I want to make, and I know you play cards, play a little poker. Do you feel like that investors kind of showed their hands early last week with just the panic that we saw, the rush to the door and some of the most crowded names, that sort of thing on Monday morning? Or, it just feels like there's an itchy trigger finger.
Yeah, I mean, and I know when you say investors, you're speaking about the market. So I will push back only on that word and say I don't think investors play any role in this whatsoever. I mean, I think it's just a function of machines taking over and that's sort of the market that we found ourselves in, which is fine. And it works on the way up, but you see how quickly things work on the way down. So I think your point is well taken. You see what a hair trigger the market's on right now in terms of, anything seemingly out of the ordinary coming out of left field, what it can do to the market on at least a 1-day basis. I still would submit we're in for something a little longer. I'm hard pressed to believe that was it, but we'll put up an S&P chart, at least through the lens of the futures, and say, wait a second, Guy, this looks just like what we saw back in April. If you go back and look, you had that downdraft over the course of a couple of weeks, culminating in sort of one fell swoop of 1 day. In April, we didn't get to the moving average. Seemingly, we did this time, and then the pretty dramatic bounce back. I mean, people will say, what's different now than what we saw? You can go back to October, November, or March into April. It's the same type of thing. So a bit of an overdue sell-off, but a pretty swift reaction back to the upside. And maybe that's all it will be. And maybe, by January of next year, we're going to be talking about S&P 6,000. I don't think that's the case, though. I think the damage has been done. Now, if you look at this chart, you'll say, well, it doesn't look like a lot of damage to me. But, to your point about the market showing its hands, I think we've seen what can happen in the wake of or in the midst of some pretty bad news.
Yeah, no doubt. I mean, listen, we're probably 4.5% or so from those recent highs made last month. We're, at our lows last Monday, we're down about 10 or so percent here. And so this is kind of a crucial area, I would say. We have CPI tomorrow morning, and let's assume that it comes in just a little light the way PPI did. The question is, do we have that sort of continuation? Because listen, I know most folks were really focused on tomorrow morning, but the fact that we're having this sort of reaction, if we can't rally on a softer number, it might be that careful what you wish for scenario, right? Where, okay, we start to think about what is, a deflationary environment look like, with low growth. And you know what that is? I mean, I don't know. So I'm with you, Guy. Let's look at the NASDAQ futures here. When you look at the E-minis, this is the 100. You can see that they are further off their highs, right, than the S&P. Do you think that if we were to have a move back towards the highs in the S&P 500, is there a way that it's led by different leadership?
No, I don't.
No.
I don't think. I think the math suggests that there's no what. For that to happen, you literally need all the other 475 stocks to participate in a major way, and the other 25 or so to sort of be left not on the side of the road, but sort of running in place. And I just don't see that happening. In order, again, in my opinion, in order for the S&P to make the next leg higher, you're absolutely going to need the participation of the same names we've talked about for the last 2 years, because the math just doesn't work otherwise, unless you have some sort of skew that we haven't seen in, as long as I can remember, in terms of just the number of stocks dominating over the more important few.
Yeah, it's pretty interesting also that the Nasdaq 100, the futures here are down about 9% from those highs last month, which is basically double of what the S&P is down. So we have seen, unusual weakness. You saw a lot of folks, or whether it is machines, you know what I mean? They're programmed by people. Well, I'm assuming that we haven't reached the singularity yet, Guy, where we have machines programming machines and they're smarter than most humans. But I mean, Elon thinks we're all living in a simulation, so who knows what's going on there. But again, I'm with you. You and I thought this coming out of 2022, where a lot of folks were suggesting after that bear market there has to be new leadership. It can't be, what I mean, the 10 largest tech stocks. Well, you know what it was? It was the 10 largest tech stocks, and then there were some new entrance to that. Nvidia took over for Tesla. Well, Tesla got down to, I think, a $500 million market cap, or a $500 billion, excuse me, got down to 500 billion. That's maybe even a lower, Guy. So, again, I think the leadership, I'm with you, has to come from those 10 largest names.
Take a look at yields because, as much as they've been a story, and, it's what's interesting about this is Leslie Picker did an interview with, we mentioned this, I think, yesterday on the tape or maybe late last week with Jamie Dimon in Kansas City. And Jamie said a bunch of different things, but one thing that really resonated with me is, he believes the market and pundits put way too much emphasis on Fed speak and furthermore, what the Fed actually does. And he's not convinced that's as market moving as we are led to believe, or at least people like me lead people to believe. So that's interesting. And you know what? To a certain extent, maybe he's onto something, because if you think about it, I mean, think about the volatility in yields. But other than this, little bit of a sell-off we've seen recently, the market doesn't seem to care whether yields are higher or lower, seemingly. It doesn't really seem to have all that much of an impact, maybe for a day or two. But, the smoothing mechanism suggests the market's not as rate sensitive as maybe I'd like to think. But here we are. You saw that downdraft in yields the same day the market sold off, and you've seen the sort of the uptick back in yields. You see the sloping moving average back down, which suggests, maybe we can trade back up to it in terms of an interest rate. So maybe, on time decay, we get back up to 415 or something. But, this seemingly suggests that, at least in the short term, we've probably seen the peak in yields back in April of this year, April, May of this year.
Well, I'll just say this about, that downward sloping 200-day moving average and maybe a move back above 4% in the 10-year. I mean, the Fed next week at Jackson Hole, or Jay Powell, would have to kind of, push, I guess, investors off the notion that they are going to cut 25 basis points at the minimum in September for yields, in my opinion, to rally. I think it's worth noting, and maybe Amanda can pull up the Dixie, the US dollar index. I mean, look at where this has come from, Guy, in the same period in which, you've seen yields come in, and that makes sense, right? But, the Dixie is also, probably weighing on crude oil, right? Like, think of this a little bit. And so look at that move in the dollar. It's obviously a pretty sustained sell-off. You see that it kind of bottomed out last Monday, right where we were back in March or so. But again, this is probably an important part of this whole macro mosaic. Let's pull up crude for a sec, Guy. And you and I were looking at this from a bullish standpoint. Last week, we turned around a bearish view and we said, what did you call it? There's something to call it. You said trading the double, is it?
Buying the double. In other words, you had said you thought this would trade lower. You thought we could get down to sort of the June lows, which happened. And then we said, if you really want to be aggressive, if in fact you had that type of position on, buy the double, meaning you cover your short, which makes you flat, and then buy more, which makes you long. And that actually proved to be correct. Now, here we are right at the moving average. Do we make that one, another sort of foray up to the low 80s and sort of test that July high, or do we sort of fail here again? But, that proved to be correct. Those lows that we sort of flagged last week held up actually pretty well.
Yeah, and not only that, I mean, it's interesting that we've had these growth concerns, but we've also had, things in the Middle East kind of get dialed up a little bit. So you have two kind of competing narratives. And I think when we looked at crude last week, we also looked at copper, right, which can't get out of its own way. So, it's a tough macro market here. Let's look at some of these oil service names, because you and I were talking about the OIH
Yeah.
earlier. It looked like it was like back on its horse, guy, just a few weeks ago, right? And it looked like it was going to go back towards those April highs, and then in 2 trading days, it just gets absolutely flushed.
Incredible, right? Some of the commentary gets around the space, but the underlying look, the market did not help. Obviously, that move in the broader market took the wind out of a lot of things, but that coupled with the fact that since then there's been this reemergence, at least for now, of the tech trade, which also hurt. So whatever rotation was going into energy stopped on a dime. But again, are we at levels now that are interesting in terms of the underlying equities? If you think about it, crude oil, as much as it's moved up and down, is basically gone nowhere. But you've seen outsized moves in terms of volatility in some of these ETFs and some of these individual names. So I look at the OIH here and say, you know what? The same way the crude probably bottomed, you could play sort of OIH against 290 on the downs, 285 to 290 on the downside, and look for a move, maybe not only back to the moving average, which I think comes around 312-ish, or maybe up to sort of those mid 320 levels, which is effectively where we broke down in a straight line.
Yeah, and it's worth noting, to the point that you just made, where crude is like year over year. Look at the XLE. So we know that 40% is Exxon and Chevron. I mean, it is basically right where it started, or where it was a year ago in September, right? So it's interesting that they had that massive move, right? And from early this year up to those highs. I can't remember really what that was predicated on. Was it growth?
You had an ExxonMobil earnings release. It took, and it's interesting. You actually, before the show, we were talking about this. If Amanda can throw up a longer term Exxon chart, it looks as though there's an uptrend line that's been in place for quite a long time. And there's this sort of, we've been in this sort of downtrend that I think we've just broken out of. So I think you would look at this and say, maybe we're making a little bit of a pennant formation, and the moving averages are actually working for you now, turning up in a meaningful way. So I look at the XLE here and say, you know what? I still think Exxon goes higher. ConocoPhillips and Chevron, throw those three in the mix, and that's where you get half the ETF. And I think you can still play these from the long side. All service a little bit of a different animal without question, but these big cap integrated names are seemingly a bit on their horse here, Dan.
Yeah, look at this Exxon. Amanda, if you could draw, an uptrend from those late 2020 lows, right, and attach it, 2021, it didn't kind of get there, but you had that move in late 2023, and then you look at it a little differently, guy. You don't even have to say that it's kind of been sloping lower. I mean, you see a consolidation for like the last 2 years or so, right? And so, is this suggesting that we're about to have a breakout? I mean, this looks like you want to play it from the long side.
I agree.
We're gonna have to get Carter on this on Thursday, especially relative to crude, how it acts right here.
It acts okay. That's that's the thing. They've been hanging around. Listen, and the downdrafts have been like shit. Once again, a bit of a fake out, but it's not unlike what we're seeing, in my opinion, in some of these gold mining stocks. You have these moves higher. They look to be unabated. Then over the course of a couple of days, it gives a percentage of it back. You're like, once again, I've gotten faked out, only to wake up a week or so later and it's right back to where they were. So, yeah, I mean, I think I've been pretty clear. I still think energy is in play here. It doesn't look like it, but it's been. I think there's a resilience to this trade. Let's put it that way.
Yeah. Last thing, Amanda, if you could just take this to a 1-year chart, I think it's kind of interesting. You can go from the January lows, and it's almost absolutely perfect here. And it just, you make a series of higher lows over the last few months or so. And I mean, as Carter would say, it's almost to the penny, right?
Mhm.
So the idea that we had that downtrend from April to the lows, just in mid-June or so, you also have, a nice uptrend that's kind of forming here, so there's your pennant a little bit. So let's look at this
Well,
later.
what's interesting is, so real quick, Amanda, so that downtrend line, so this is what I would do differently. I would draw it with a steeper angle, and you can actually say that we've broken through the pennant. We've had some back and fills along the way, and so move that line down. And if you go those prior tops, you'll see what I'm looking at. So instead of that trend line, so you go from that prior high. And I'm sorry we're doing this on the fly, and then draw the downtrend, and you'll see that we've broken it. The pennant's been actually broken. There you go. And you can see that a few times along the way, we've tested it. bounced through it. So I would submit we broke this pennant a while ago, and we're just doing some work here before we take the next leg higher. So that, and again, that's just a bunch of different people looking at charts a bunch of different ways.
Well, let's get somebody on Thursday to kind of break, like not this armchair quarterback stuff that you and I are doing. Let's get Carter on this one. All right. So here's, this one was kind of interesting. So Carter this morning had a note out on Deere. And so let's just kind of run through this really quickly because they report, I think,
Thursday, I believe.
Yeah, before the opening. You see those kind of levels that he thought were support, or he would have called out as support, and we just broke that right here. These, what he would say, very symmetrical lines mathematically. He thinks we kind of get back towards kind of that earlier mid 2022 level. You see the pennant that we just broke through. If you want to move through for 2 charts here forward. You see this, there's the very, there we go. Look at that one, Guy. So when you think about that, I mean, into the earnings, 5% implied move in either direction. Thoughts on Deere?
Well, if it's, again, if we're seeing, like, if PPI and some of the ISM numbers suggest things are slowing, Deere will be sort of at the front of that in terms of how they will fare. So this pennant formation, the same way we just looked at a pennant formation seemingly breaking the upside, the same thing is happening here to the downside. So if he's right, and if the services numbers and if the economy is slowing the way it seemingly is, and if there's this inventory build amongst dealers at Deere, you'll see it in the form of a lot of different things. And you could see that knee-jerk reaction to the downside without question. You can see, we've gone basically sideways here. It's been a bit of volatile stock, but outside of that huge ramp in 2020, I mean, this is a stock that's been going sideways and now seemingly starting to roll over. We don't have the moving averages here, but the moving averages are probably flatlining as well. So, this suggests a move down to probably 290-ish, which was that low that we saw in 2022. Makes some sense to me.
Yeah, it's crazy about that move in 2020. I mean, just how quick, that down 35% in the S&P was, right, from its highs in March of 2020. It didn't take long to kind of get back towards the prior highs after that huge drop, and then just the runaway on these sorts of things. And we make this point all the time. You have that sort of move, you're going to have the sort of back and fill. You're going to have this sort of, stealing from the future from a performance standpoint. You know what I mean? And this is a great example of that, because some of the growth that move was implying once it got back to the prior highs and then just took off. I mean, it's just hard to grow into that valuation here. You know what I mean? So I think that's pretty interesting. Deere's down 13% of the year. Maybe we have a cat chart really quickly. This one's up 13% of the year. So it's always interesting. Danny Moses mentioned this on the Tape podcast on Friday. For every cat, there's a deer, you know what I mean? And we go on and on. Every Walmart, there's a Target. I mean, we could just, NVIDIA, Intel,
Home Depot, Lowe's. He mentioned a few, GM, Ford, T-Mobile, Verizon, AT&T, without question. I mean, they're winners and losers.
Yeah. Hey, so Guy, we walk in this morning and Starbucks replaces their CEO with a CEO that is often, meant to just kind of be not meant to, but he's thought of, as just one of the premier CEOs in the restaurant, quick serve business. What does that mean to you? Like, to see this sort of move just on the replacement of a CEO, like how much does a CEO really able to affect this? This is another great example. I mean, like there's some real huge challenges that Starbucks has that they've tried to combat with some tech and this and that, whatever. But China is a bit of a disaster there.
Yeah.
Like what is one CEO, some change in the C-level suite? Is it worth 20% in the stock like that?
Well, I mean, if you look at the performance of CMG since Brian Nickel, started his reign, and what they've been able to do on the technology front, and their efficiencies and their margins and their growth, their expansion. I mean, he's really done a really good job on what's been, for some of these restaurants, a pretty challenging environment. So the market is saying, you know what, if he could do it at CMG, he could definitely do it at a more well-established, maybe more mature brand like Starbucks. I think this says a couple things. Current leadership was waning or just lacked vision, and obviously was an operational problem without question. And to a certain extent, I mean, if you just think about your daily lives to the extent that you go to Starbucks, it's a much different experience. And when I say different, it's a much worse experience now than it might have been 5, 6, 7 years ago, without question. So if you can sort of move the needle on that front and get some of these operational efficiencies back, theoretically, it should help margins, which should help the bottom line. So it's not a ridiculous move in terms of what he could potentially do at a place like Starbucks. Outsides, yes, but we could talk. Listen, we could be talking about this time next year. Remember when Brian Nickel took over on that lazy day in August, and that proved to be the bottom? I mean, that could very well be the case. And if you look at a longer term Starbucks chart, this is a static one, but you pull one up, you can see, maybe the worm has turned a little bit here in terms of the stock, and all it needed was, a different piece of vision. And we traded down to those lows from 2022, seemingly held. I don't know. It's not going to go up in a straight line, but you might have put the lows in for quite some time here, Dan.
Yeah, I'm a bit skeptical that, we're going to see an immediate turn, because I think some of the macro factors, that are at play are really going to be huge headwinds. But again, you could be totally right about the lows in, but I could also see it going back and filling in a bit of that gap and kind of being stuck. And, you and I were talking right after the open. We were thinking about, okay, who might else be in play? What sort of stories might a CEO who's presided over a very difficult period and not executed particularly well? I think you and I both agreed Nike would be kind of an interesting one that had that huge gap, about a month ago or so after earnings. And we want to pull this thing up and then pull up. I mean, come on, that gap is meant to be filled at some point. Yep. I think there's probably an activist out there who says, you know what, let's get going here. Let's see if we can push out this CEO. Let's look at a day chart, though. This one kind of got away from us. I don't know. I didn't think it was going to get going up 5% or so. So that kind of clearly, makes you think that other investors are thinking about this guy. So thoughts on the potential for a Nike here, because you would agree that today's move really only has to do with the potential for
100%. So pull up a longer term Nike chart. I agree with you 100%. And Nike's problems are a little bit different than Starbucks, I think. Nike competition, a huge factor without question. I think they sort of lost their way for a period of time, and obviously the China. So as much as there's similarities between Nike and Starbucks, I think Nike's a little more challenged now than Starbucks. But with that said, that's your chart. If you just go back to that prior chart, you see the potential, again, if you get a piece of good news in Nike for one of these island reversal type of things where you basically just saw the same thing in terms of Starbucks. So this is one where risk reward, maybe you got to risk down to, I don't know, $70 or something. But on the upside, you could walk in one day and this thing could be trading 82 on the back of a similar type of announcement. So I think the move makes sense, and the setup is eerily similar.
Yeah, and so obviously, if we're thinking about Nike and some of the issues that are ailing it, we got to go to Lulu here. And so you just mentioned competition. Lulu's got a lot of competition right now, whether it's Alo, whether it's Athletic, whether it's Viore, and obviously there's been some mis-execution here. But this one, got me thinking about it in the same exact way, Guy, that we were just talking about Nike. And let's just throw up this quick slide here. So for the first time in a long time, Guy, valuation looks attractive if you believe the forward estimates here. Okay. So this company's going to report in a few weeks here. Let's see. I mean, the stock's down 50% from its 52-week and all-time highs. That just happened, people, in the last 6 months. The technicals looking a bit interesting here, okay? And then, we'll just throw in that activist thing. So I want to play this from the long side. I want to define my risk. I want to give myself a few months here, okay? And I want to be bullish on this sort of thing. So today, look at that downtrend, right? You see where that kind of line is. If you get above that, you could have a move back towards 300, and maybe there's some sort of impetus that could cause that to happen other than earnings. So today, when the stock was trading about 242.5, I bought the October 260 310 call spread, trading about $10. I bought to open one of the October 260 calls for about $13, and I sold one of the October 310 calls about $3. So I paid $10 for this. My break even on October expiration is up $10 at 270. I have gains of up to $40 between 270 and 310, and a max gain above 310. And then I have losses up to $10 between 260 and 270, with a max loss below 260. This trade risks 4% of the stock price. It breaks even up about 11%. I have a max potential gain of about 16% if the stock's up 20% on October expiration. And, as is the case with all long premium directional trades that we talk about here, let's use a 50% mental stop. If this premium of 10 gets down to 5, if the stock goes nowhere or goes down, we're going to want to cut this because we don't want to see it go to 0. And the last thing I'll just say is like that 270 break even, the options market is saying there's about a 35% probability that that's in the money. That's not so bad if you think there are some catalysts going forward. Generally, we don't like to think about trades with this wide of a break even, but this one could have some catalysts in it.
Well, the catalyst is going to come in the form of earnings in early September. It's either the first week of September or early in the second week of September, number one. Number two, at this point in the stock's life cycle, and that's your chart, but if we put up a longer term chart, you can see, I mean, the sell-off has been dramatic. It's one of these situations where, if they can just come out with something that shows stabilization, you'll get a knee-jerk reaction to the upside. And last couple of quarters, they've seemingly got their inventories in line. If you look at the drawdown year over year in inventory, it suggests that, if sales growth were just to stabilize, they're going to see margin, maybe not improvement, but stabilization, which I think at this point is really important. I don't think they're fixed, and I don't think you're saying they're fixed. But what I do think could happen is you get sort of these knee-jerk reactions. So the time duration in terms of the trade is right. And I think a 4-to-1, and I think that's the math in terms of win-loss with a 35, maybe 40% probability. Yeah, I'll do that every day, I think, Dan.
Yeah, and again, like I said, I don't love how far the break even is away, but again, with the catalyst, if we get through earnings and they're not bad, and maybe they're slightly better than expected, and the forward numbers are intact, then at 17 times, this stock looks really cheap relative to its historical. But are you surprised that this one has not rallied the way a Nike is rallying today?
Yeah, I am. It's been and they're clearly, Jeff Mackey used to say that specialty retail is where hope goes to die, and Lululemon is, for whatever you say, it's a specialty retail company. And when you're in that growth portion, it never feels like the stock is going to go down. And then once that growth stops, and it stops sort of on a dime, you see how quickly the turnarounds are, and it takes a long time. A good example of this, by the way, is Abercrombie and Fitch. I mean, not to get off the rails here, but that was left, that was a great growth story until it wasn't, left for dead. It took years for that to turn around. So in terms of what we're seeing here, I'm not necessarily surprised, although, you just think on the back of what we just saw with Starbucks, maybe to get some short covering. But yeah, it's a challenged business without question. And when competition comes in and you become sort of commoditized, which effectively is happening, you see how quickly things turn. But again, in terms of this trade, this trade does not suggest they fix their business. What this trade suggests is you're going to get a catalyst. And if they were to come in, in line or slightly better, you'll get the commensurate move to make this trade a winner.
All right, before we get out of here, let's look at gold. We were talking about it last week. You thought we'd have a little bit of a back and fill. You were not surprised that, it was correlated to what happened early in the week, right? Well, here we are, Guy. We had a good couple of days here, and we're approaching those prior all-time highs, just made, I want to say mid last month here. And you mentioned this all the time. You continue to move that stop up, and you get more bullish as it kind of has the potential to break out. We've had a couple false breakouts. You had that nice move about a month ago or so. What is the thing that causes it to really break out? Is it something geopolitical? Is it the dollar falling out of bed? What do you think is the impetus for new highs and establishing a new range would be the other?
No, I think that's fair. I mean, it's done the work that it needs to do. I think, again, if the current environment that we find ourselves in globally continues, which I think it's going to, by the way, gold is going to continue to win. And what does that mean? I mean, obviously, you have an election cycle here, the geopolitical unrest, not only in the Middle East, but Russia, Ukraine, for whatever people, I mean, that's still out there without question. That has not gone away. Central banks continue to buy gold. And now these currency moves that we're seeing, which I think dollar yen is the first of many type of situations that we could see currency volatility. So I think all roads lead to gold on the back of it. And every false breakout, you're right, there have been a number of them that have given it back over the next couple of weeks. But each one then subsequently has been retested and breached to the upside again. So I think that's what we're in the midst of here. And finally, some of these mining stocks, which again are volatile, are starting to pick up some steam once again. So I just think you sort of stay with this under the assumption that, you know, the world that we live in, it's going to be status quo, and status quo is good enough for gold.
All right, one last thing. I said that was the last thing. One last thing. Here we are today. The NASDAQ futures, the NDX E-minis, you know, the 100s are up 2.3%. And I just want to go to the Mag 7 here. So massive outperformance, NVIDIA up 5.5%, and then Tesla's up nearly 5%. But aside from that, Microsoft underperforms the NASDAQ, Google underperforms the NASDAQ, Apple underperforms the NASDAQ, Amazon does, and then Meta's up about in line with that. What is that telling you? That the memeiest of the Mag 7 are raging right here, and the other ones are underperforming a little bit.
Well, it tells me maybe we're not on as stable footing as the market suggests we're on. I think there's the damage, in my opinion, the damage that we saw last week has been done, and it's going to last for a while. And I think you're going to see, again, I didn't think we'd be this high this quickly on the back of last week, but here we are. But, you know, I do think we find ourselves in an environment where volatility is still going to be a story. So NVIDIA is not out of the woods by any stretch. It did fill that gap to the downside, which, by the way, we thought it would. We had said that for a while, and we started saying that back on June 20th. But NVIDIA reports, and, you know, if you look at some of the, again, it's not about the spend at this point. We know the spend is there for NVIDIA. It's about whether margins improve or, you know, whether we can start to see a slowdown, which is inevitable historically with semiconductors. So, you know, I don't think what's changed are the prices, but the fundamentals to me haven't changed.
Yeah, I guess you're right. I mean, some of the things that took down Microsoft and Amazon and Google after the reports, you know what I mean? They're all still intact. Just because you've had a really sharp rally in the market, you know what I mean, off of those lows over the last week doesn't change the fundamentals of these companies, and it doesn't change some of the macro factors that we've been tracking, consumer confidence, you know, obviously the employment stuff. So whole host of things. All right, CPI tomorrow, guy. Main event here, man.
Yeah, real quick, just one question. We have a few, but we have time for one. So Jack CF asks, when is CMG a buy? I think the answer is today. If you look, I mean, it's been bouncing off the lows we made early all day. It's already traded 80 million shares. I think it typically trades about 17 million a day-ish. Dan, you can look at that and see if I'm right, which suggests we're probably going to trade, I don't know, maybe 6 times normal volume. I think, you know, if you look, this sell-off since, I guess, the announce of the split to a point, but since June, sort of had me scratching my head. But now maybe it makes a little bit of sense. You know, maybe there's some people out there that caught wind of this whole Brian Nichols news, sort of sell the rumor, and then today could be buy the event. So, yeah, I think to answer your question, Jack, today's the day. Today's the day you've been waiting for, in my opinion.
Well, and the average over the last month or so has been about 13 million shares. So
so it's actually,
trade 100 million today, right? And you know, it's not lost on this guy that from late October of 2023 to its recent highs, I mean, the stock nearly doubled, right? So here you are, you have this crescendo of selling on big news. Like, let's be frank, you know what I mean? This is not sort of small news, but just like we said that, or at least I said that, I don't think him going to Starbucks is like, take it to the bank, it changes the whole story. I'd say the same thing for Chipotle, especially how much it's been down. You're kind of discounting a bit of this right here, in my opinion. But to your point, it opened on the lows, it's trading at the highs. Let's see if it fills in the rest of that gap.
Go ahead with Market Matrix. I know you want to end with it.
I know. This is a little housekeeping here. You know, we're really excited. Guy, are we in week 13?
No, I think it's longer than that now. Amanda can get in your ear or text us, but I think it's 14.
All right, 14 maybe. It's MRKT Matrix. You can find it in your favorite podcast store. Follow it, rate it, review it, share it with friends. What is it? It's our new AI-generated podcast. We curate what we think are the 10 most important stories in the market and in business. We put them in a large language model. It summarizes it. We put it in a voice bot. Our main man, Brunson, who's not real, but he reads it to you in under 10 minutes. So we really enjoy putting this together. We hope you guys enjoy it. Share it with your friends.
That's it, folks. We'll be back tomorrow. I think, Dan, EYT is joining us tomorrow.
That would be Liz Young Thomas from SoFi. It doesn't roll off the tongue the same way, guys.
It's not the same.
She'll be with us. Hopefully, we'll all be together, maybe in the studio, and we're gonna have a lot of fun. So
looking forward to it. Thanks, folks.
Thanks.